Well, good morning, everyone. As you know, the U.S. Treasury Department recently issued new interpretations on its own Paycheck Protection Program. And then the president recently signed a new PPP Flexibility Act, relaxing the PPP rules in important ways. So to help us make sense of all the changing landscape, we're happy to welcome back Becky Phillips and Theresa Batliner with MCM to help us plot our PPP path from here. But before we go any further, I just want to take a brief moment to review the functionality of our Zoom webinar. Right now, I have everyone on mute to avoid any background noises that may distract you from listening to the webinar. And for this presentation today, we will not be using the chat function. Instead, however, if you do have a question, please enter them in the Q&A box below. You can access that by clicking the Q&A function at the bottom of your Zoom window. If you see a question that is similar to yours or one you would like to make sure we get to, you can tap the thumbs up icon to the left of the question, and that will move the question up to the top of the queue. At the conclusion of Becky and Theresa's presentation, we will answer any questions that come up. For questions we don't get to, by the time that we end at 10:15 today, we will answer offline and follow up via email. This webinar is being recorded, and a link to the video along with the PowerPoint presentation will be emailed to you all and all those who are registered by the end of the day tomorrow. I also just want to take a brief moment to thank our members and supporters and board of directors who enabled us to bring you this webinar today. Since the pandemic stay-in-place crisis, we have been able to bring you some of the very best thinking about how to navigate this crisis free to the nonprofit community. If you are a member and your membership is up for renewal, I hope you consider renewing. And if you're not yet a member and find value in the webinar and any of our associated resources or support, I hope you will consider joining. Make sure you're signed up to receive all our latest information affecting our sector through our e-news and our resources. You can sign up to be on our mailing list by visiting our website at cnp.org. And finally, we want to invite you to join and participate in our nonprofit community connections group on Facebook. There you can share and learn from your peers, and where we together can begin to explore our future. Now I'm happy to introduce our presenters this morning. Theresa Batliner is a member of MCM's not-for-profit service team, Insurance Services Department. Her practice emphasis is providing audit services to nonprofit organizations and employee benefit plans. She's also a management advisory services, including internal control evaluation. She serves on many community boards, including Nazareth Home, South Louisville Community Ministries, and Mercy Academy, among others. Becky Phillips is director of the firm's nonprofit service team. Her practice emphasis is providing audit services to nonprofit organizations and local government, as well as non-publicly traded businesses. In addition, Becky oversees the firm's women's initiative, the Women's Inspiration Network. She's also on the board at CNP and serves as our treasurer. With that, thank you both for your time today. And Becky, I'll go ahead and turn it over to you.
Thanks, Merv. I appreciate it. A lot has happened since we were with you all at the beginning of May. And you remember at that point in time, there were a lot of questions that still existed on how we were going to handle much of what's included in the PPP forgiveness component. The good news is that with a lot of the information that we're going to be sharing with you today, the guidance that's been provided since we were with you in the early part of May makes it very apparent that the real goal of the government at this point in time is to provide you 100% forgiveness of your PPP loan. I think that what you're going to find is that in many of the provisions that we're going to talk through today, it's going to provide you with the ability to get 100% forgiveness. So that's the awesome news that we're going to be working through today. So the first thing that we're going to be talking about in things that have happened since early May is some definition on the payroll periods, the paid or incurred language, the ordering of the forgiveness reductions. You'll remember that there was the way that you ordered those forgiveness components of the reductions had a big impact on forgiveness. Mitigation and rehiring rules, a new alternative seasonal method, the calculation of full-time equivalents, and then the use of restricted funding sources and PPP funds, and whether we could double dip in essence. So the first thing we'll talk about is the payroll periods themselves. So there was the provision that was going to now allow those that are using biweekly or more frequent payroll periods to use an alternative payroll covered period that really aligns a little bit more closely with your payroll cycle. So the standard period is 8 weeks, and we see that we now have the ability to use a 24-week period that is supposed to begin on the date of the loan disbursement and ending 8 weeks or 24 weeks later, but in no situation beyond December 31st of 2020. But this new alternative period is an administrative convenience that is provided to those folks that desire to use it, that are either on a biweekly or more frequent payroll cycle, that allows you to use the first payroll following the date of the loan disbursement and continuing for 8 or 24 weeks. The problem for some of us is that it does not allow those folks that are on a monthly or semi-monthly payroll to use this. So let's kind of just look at a real quick example on that. Let's assume that you got your loan, the disbursement of your loan was on June 3rd, which is a Wednesday, but your payroll cycle always runs from Monday through Friday. So the next payroll period beyond the Wednesday, June 3rd disbursement date for you would be June 8th. That would be the period that you're going to start, should you desire, since you use weekly payroll, to use as your alternative covered period rather than the date of the disbursement of your loan. So that's a big convenience for a lot of folks that do have the weekly or bi-weekly payroll. So the paid or incurred language. You remember that previously we were with paid and incurred, and that created a major issue with regards to what all could be included in the forgiveness calculation. So now that language has been changed for us, and it is paid or incurred rather than paid and incurred. So really what this does is it allows for expenses that were both paid during the covered period, whether it be 8 or 24 weeks, and we'll talk about that extension of 24 weeks in a minute, or that have been incurred but not yet paid during that period. So this is going to be applicable for our payroll component if all prior payroll amounts paid during the period, plus those amounts that are paid during the next payroll period, but were incurred during your covered period. And the same is going to be true with regards to our non-payroll cost. So with our non-payroll cost, if we paid it during our covered period, or if it was incurred and then we pay it before the next billing date, the next billing cycle for that particular, like for instance, utilities. So with the paid or incurred language, if it's paid during the covered period, all of it counts. If it's paid during and incurred during, all of it counts. If it's fully incurred, but not paid during the covered period, but it's paid at the next regular due date, all of it counts. If it's partially incurred, but not paid, but it's paid at the next regular due date, part of it counts, and in this particular situation, you're going to prorate it. So for our payroll cost, when we're looking at what's paid, obviously, it's the check distribution date or when the ACH transaction is initiated, should you be using a payroll service or paying your folks through ACH. If it's from an incurred standpoint, we're looking at what was earned during a period. That's the incurred element. And another clarification here, remember this was a big question last time we chatted about bonuses and hazard pay. Well, that's going to be included, bonuses and hazard pay, as well as any amount of wages to furloughed employees. So we're starting out at the beginning of the covered period using cash basis, but when we get to the end of the covered period, we're moving to an accrual basis. The same is going to be true for our non-payroll cost. If it was paid during the covered period, or if it was incurred and paid by the next regular billing date. Again, we're starting the period using the cash basis, but we're ending the period using the accrual basis. One big caveat to note here that's really important is it's possible to have two covered periods for these non-payroll costs. If you're using the alternative payroll coverage period that I mentioned just a few minutes ago, you can use that alternative covered period for your payroll, but you cannot use it for those non-payroll costs. You're still going to have to work with the 8-week or 24-week period beginning with the date of the disbursement of your loan. So the ordering of forgiveness. As I indicated, we previously talked about the fact that that could have a big impact on the amount of forgiveness. So what we have found now, based upon the information that's provided to us, is once you have calculated your payroll cost for the period, we are going to look and take a reduction first for any pay rate changes of 25% or more for those employees that make a greater than $100,000 per year payroll amount. Next comes the reduction related to the full-time equivalents. When we take that reduction, obviously, because remember we have some periods that we can choose from, we want to use the most beneficial of those time periods for us. So then we determine the amount that's eligible for forgiveness, and that's compared to 60% of the total loan amount that was actually spent on the related payroll costs, and then take a reduction if it's applicable. That 60%, you remember that previously was 75%. That has been reduced to now 60%. And you remember when we talked about the 75%, there was some question that was out there as to whether that 75% was a cliff or not. So that if you didn't spend 75% of your loan proceeds on payroll, then you didn't get any of it forgiven. The question then was still now, if we got 60%, we wouldn't get, if we did not spend 60% of our loan proceeds on payroll, then we wouldn't get any of it forgiven. That's been clarified for us now. That's not the case. So this is not to be considered a cliff. And we're going to see an example of this calculation in just a few minutes. That's probably going to make it a little, at least for me, a little bit easier when you drop numbers in the buckets and kind of see how it flows through, rather than just talking conceptually with these amounts here in this forgiveness reduction. So the mitigation and rehiring rules. The instructions now provide the allowance for the mitigation of full-time equivalents and payroll reductions if the situation is mitigated by December 31st of 2020. we see that we have gotten the ability to extend that payroll period. This didn't happen in the May time period, and we're kind of running through some of this chronologically for you here. It happened in June 5th with the Flexibility Act, that the 8 weeks was extended to 24 weeks. So if you received your loan before June 5th, you have the ability to look at 8 weeks or 24 weeks. If you received your loan after June 5th, you look at the 24-week period as being your covered period. Well, obviously, if we're looking at a 24-week covered period, we're going to have to go beyond June 30th. And that's where that December 31st time period came into play for us, giving us the ability to make this mitigation beyond the June 30th time period. There's no guidance as to how long after mitigation you have to continue with the rehiring or the pay reductions reinstated. And then there's also a little bit of information related to full-time equivalency reductions in the instructions as to what you do not need to include. So we have the example of the full-time equivalent does not need to be reduced if you've made a good faith offer to an employee to return to work and that was declined. You remember that existed previously. Employees who were hired for cause, voluntarily resigned, or voluntarily requested and received a reduction in their hours, that existed previously. Now we've got a couple of new ones that have come into play. First, if you are unable to hire individuals who were employees on February 15th of 20 and unable to hire similarly qualified individuals for those positions before the December 31st date, or you are able to document the inability to return to the same level of business activity as what you had on February 15th due to compliance with COVID restrictions. So in the mitigation and rehiring date rules, we have this new date that has come into play. Previously, we were looking at the June time period, as I mentioned before, and now we're at the December 31st time period. Again, the need for the extension primarily due to the fact that we have this 24-week period. We also have the use of an alternative seasonal period. So this alternative seasonal period is a 12-week period during any time during the period of May 1st of 2019 through September 15th of 2019. In the prior guidance that was provided by the SBA, this was an alternative calculation for purposes of determining the maximum amounts that can be borrowed, and the instructions now provide us the ability to use this same time period in our forgiveness calculation. So we got a little bit of ability to simplify things and some instruction too with regards to the full-time equivalent and how to calculate that. When we were together in May, we talked about what's considered, how many hours is considered a full-time equivalent, and thought that there was a possibility that 35 was going to be used. Nope, it's been clarified. We now need to use 40 hours in the calculation of our full-time equivalents. So the 40 hours is one full-time equivalent. Even if a person works more than 40 hours, it's just considered one full-time equivalent. But we have a method. I don't think that most people are going to find this method beneficial, but it is a simplified method for you to use. such that if an individual works 40 or more hours a week, they're considered one full-time equivalent. Anyone that works less than 40 hours per week is considered 1/2 of a full-time equivalent. And this is calculated for each employee for each pay period. So let's see how this works out whenever we do this calculation. So we have in the top example, we're using the 40 hours per week. And our first individual, Ricky Bobby, worked exactly 40 hours, and that is considered one full-time equivalent. Cal Naughton worked 52 hours, which really is 1.3 whenever you divide by 40 hours, but that's capped at 1. Jean Girard worked 42 hours, again, one full-time equivalent. Our next individual, Cole, worked 35 hours, which works out to 0.88. The same calculation methodology is worked for the following two individuals, which gives us 4.9 full-time equivalents. When we use the alternative method, we can see that the changes that are taking place in our individuals are the bottom three, and Cole, Rowdy, and Russ are all calculated at 0.5 rather than at the actual calculation dividing by 40 hours per week. This comes out to 4.5 full-time equivalents, not as beneficial as using the actual hours or the 40-hour method example up above. So I think that it's going to be important if you have some sort of reduction in your forgiveness that's likely to take place based upon full-time equivalents, that you look at both methods to determine which is going to be most beneficial for you, because that's obviously the route that you're going to want to go. Okay, so a little bit of clarification here about using restricted funds to pay payroll dollars or some of these other types of expenses that are included in the forgiveness calculation, and or the use of PPP funds. So it is now clear that we cannot double dip. Double dip would be consideration of using restricted funding sources to pay these expenses, and then also requesting forgiveness from a PPP perspective. So we only get to consider these payroll dollars and these other costs in either the use of the restricted funding component or for PPP forgiveness, not both. However, I will point out that with the extension and the ability to use your funds and use or choose a 24-week period as your covered period, rather than the 8-week covered period, the issue with regards to using restricted funds and not being able to use those for PPP forgiveness is really somewhat mitigated, because you have a much longer period of time to be using your PPP funds for payroll dollars throughout the period. Before we move on, at this point in time, I'd also like to remind everyone about the payroll tax deferral that you can use from the employer FICA component. Previously, it was such that those folks that received a PPP loan could defer the employer portion of the FICA taxes up until the point in time of forgiveness. Now that has been removed completely. And if you have received a PPP loan, you are able to defer the employer portion of the FICA tax throughout the entire period through December 31st of 2020. This is in essence an interest-free loan that the organization is receiving. These amounts will have to be paid: one half December 31st of 2021, the second half December 31st of 2022. But as I indicated, that is an interest-free loan that the organization is getting. So you want to make sure that you take advantage of that through the end of this year. Okay, so let's talk about some other clarifications and changes that have taken place. One of the questions that we had that existed whenever the 8-week period was extended to a 24-week period of time is what happens with that component of amounts that could be used for individuals that make greater than $100,000. If we were looking at the 8-week period of time, that was capped at $15,385. With the extension to 24 weeks, there was nothing that indicated immediately that that $15,385 was going to be increased, allowing for forgiveness of a greater amount for a payroll for those individuals that make greater than $100,000. Well, this has been clarified. If an employer, if a not-for-profit, uses a 24-week period, the 24-week period, the maximum amount for employees making greater than $100,000 is now $46,154, which is essentially $15,385 times 3. We also had additional and modified full-time equivalency reduction waivers or safe harbors. Full-time equivalence was clarified to now be based on hours paid rather than hours worked. And it appears like the restoration of pay for full-time equivalents can now be used effective as of the application date of your forgiveness loan. So we're going to talk about this in a little bit more detail in just a minute. One of the things that I want to point out to you is that based upon the additional covered week period that we have, should you choose to go up to a 24-week or beyond your 8-week covered period, the way that the math works, it's possible that if you spend enough money on payroll during that 24-week period, that you actually can mitigate any reduction that would have taken place for full-time equivalents or pay rate. So let's walk through this example real quick. The total amount of payroll cost that was used or paid during the covered period was $113,985. You see the amount of the rent or lease payments and the utility payments, so that the total of those three numbers is $163,985. In this particular situation, there was a full-time equivalency reduction that needed to take place as a result of the layoff of individuals that was not mitigated during the covered period. The modified total is $109,870. The amount of the PPP loan was $70,000. The payroll cost at 60%, taking the amount of the payroll cost to ensure that 60% was used for payroll, $189,975. So in this particular situation, you see that the not-for-profit is receiving forgiveness for the full $70,000 loan, even though there was a payroll reduction or full-time equivalency reduction that needed to be taken into account. And this is simply because of the use of additional weeks of payroll dollars in the calculation of the forgiveness. So from a full-time equivalency standpoint, additional safe harbor, a new one was added. The first two previously had been provided. The new one, the inability to operate between February 15th of 2020 and the end of the covered period at the same level of activity that existed on February 15th due to compliance with all of the standards that have been set up by our various oversight organizations in providing us direction on dealing with COVID-19, or related to the maintenance of standards for sanitation and social distancing and any other worker or customer safety requirement related to COVID-19. Some additional information that has been provided by the AICPA. The American Institute of Certified Public Accountants has been very active in providing information to the CPA community and to others in being able to provide services in dealing with our PPP loan forgiveness. So this information that they have indicated is that all of the loans will be subject to random audits for accuracy of the reported information. Loans over $2 million, and remember we've talked about that previously, of the necessity component, will be randomly audited for the liquidity under the necessity requirement. And there is also a calculator that the AICPA has been put together. They previously had one around and it's now been revised and is available. I have the site for you listed here, and of course these slides are going to be made available. Merv will provide those out after this presentation. And also the Center for Nonprofit Excellence has this site included in their information related for your use for PPP forgiveness. So now there's a big question that has come up. A lot of organizations have said, we've used all of our funds. Maybe most organizations, if you received funds early on or at the end of your 8-week period, no one's really at the end of their 24-week period, if that's the choice that you have used. But maybe you're beyond 8 weeks, you aren't already up to the 24-week period, but you feel like you've used all of the funds and therefore you want to apply for forgiveness. Do I have to wait until the end of the 24-week period to be able to apply for forgiveness? If the safe harbor applies for full-time equivalency or the pay rate, yes, you can go ahead and apply for forgiveness now. If the safe harbors are not met, the instructions indicate that the time period ends the earlier of December 31st or the date that the application is submitted. So if you're looking at reductions that have taken place in your calculation, you're not in the scenario where I indicated previously that you have large amounts of payroll dollars because you've spent a lot on payroll, so it doesn't make any difference that you had any reductions in place. Can you go ahead and apply for forgiveness now? Yes, you can apply for forgiveness now. You do not need to wait till the end of your 24-week period. You can submit the application, and all of those mitigation elements are now based upon the date that you submit your application for forgiveness rather than waiting until the end of the December 31st time period. So that can be very beneficial to you. So if you do your calculation at this point in time and you receive 100% forgiveness, then I recommend that you go ahead and do it, get life over with and move on. If you have some sort of reduction that has taken place and the mitigation is not satisfactory for you at this point in time, then I would recommend that you overspend on those payroll dollars, so to speak, and then redo your calculation at a later point when you will receive 100% forgiveness. So I'm going to turn it over to Theresa now, and she's going to talk a little bit about the simplified forgiveness that we have as a result of the new application. Theresa?
Great. Thank you, Becky. So as Becky indicated, there are now two different applications for forgiveness, and one is considered the EZ form. I did see that there was a question that came in that asked if we know like when these applications will be available to the banks. And so the applications were actually released on June the 16th. So the banks would have them. I would imagine that much like the original application process, that each bank is going to have their own timeline for when they're going to open up to be able to start accepting applications for forgiveness, and that they were most likely, again, just waiting on this final bit of clarification that came out, over the last week or so. So I would just recommend that you reach out to whatever institution you received your loan from and just, determine what their process and timeline is for opening up their forgiveness process. So again, we now have the form 3508EZ, and this is going to apply to borrowers who meet any one of these criteria. The first is that you did not reduce salary or wages for any employees by more than 25% during the covered period compared to the period between January 1, 2020 and March 31st, 2020. And you did not reduce the number of employees or the average paid hours of employees between January 1st and the end of the covered period. But all of the exceptions related to the inability to rehire are still going to be applicable here. Then the second criteria is that you did not reduce by that same 25%, and that the borrower was unable to operate during the covered period at the same level of business activity. Again, just related to all of the requirements related to COVID-19. Now, there is no percentage like in the guidance that says like what that reduction in your business activity is, but the interim final rules that were just released do seem to imply that if you were part of like one of Kentucky or Indiana or Ohio or any state, basically their requirement by the government to shut down, that you would fall into this category as long as, again, you didn't, decrease your wages by more than 25%. And the example that they give in the new guidance that they put out, and this is on page 23 of that, talks about a business that was selling beauty products both online and in its physical store. During the covered period, the local government where the store was located required non-essential businesses to shut down. And that because of that, their activity was obviously reduced during that covered period. So they would, again, be able to meet this definition of having their not being at the same level of business activity. And from a documentation standpoint, it just basically says that the borrower has to certify that they've documented in good faith their reduction, and such documentation must include copies of applicable COVID requirements or guidance for each business location and relevant borrower financial records. So I would just assume that would be like any financial statements that you could produce that would show a reduction in your activity. So again, this streamlined form, it is expected to smooth the forgiveness application process for a substantial portion of the PPP borrowers. The form 3508EZ is just a 2-page document, and then we have some instructions with it. Whereas the original form, 3508 is about a 5-page document with, about 5 or 6 pages of instructions. So again, if you can follow that simplified form, it should make things a lot easier. So we're going to look through this form 3508EZ. So the first page, again, you're just going to have your normal information as related to the loan as far as the loan amount, your loan number and things like that. But again, the forgiveness calculation are just these 8 lines. It's very, very simple because, again, this is assuming that you have no reduction related to the 25% reduction in payroll, and you have no reduction related to your full-time equivalents. So you're just going to have payroll cost, the mortgage interest, your rent or lease payments, utility payments, add those together, compare that to the PPP loan amount, and compare that to 60% of the payroll, total payroll cost. And then again, the smallest of lines 5, 6, and 7 is going to be the amount of forgiveness. Then the second page of the application is just all of the certifications that have to be made. Most of these are similar to what's on the long form. The main difference is in, well, the first one that's listed on here, this is on both forms, but the only thing that's changed in here is that we talk about the payroll costs have to be limited to 60%. Then there's also going to be a certification that the borrower did not reduce the salaries by more than 25%. And then in addition, the borrower is going to have to certify at least one of the following items, and that's that you did not reduce the number of employees between January 1 and the end of the covered period, and that you were unable to operate at the same level of business activity. So again, as long as you can, check the first box about not reducing our salary or hourly wages by 25%, and then one of the other final two, then that's your certification that you did meet the requirements to be able to file this Form 3508EZ. So when we look at the regular, like what we would call our long form, so information related to obtaining the loan, again, when we look at this, we have something on here that's now called a line that lists the employees at the date of loan forgiveness. And this is now going to be important due to the change in the instructions related to the earlier of date that Becky talked about when we were talking about full-time equivalents and the pay reduction. Because now, again, if you choose to apply for loan forgiveness before the end of your 24-week period, you're going to use those numbers as of the date of the application as opposed to December 31st. If you received an EIDL loan, any EIDL advance is going to reduce the loan forgiveness. The covered period, again, as Becky just mentioned, if you've reached the end of your 8 weeks, you've spent the funds, you don't have any reduced pay or FTE reductions, just go ahead and apply now because you can just get it done and be able to move on with your life. Again, we have the box that's going to be checked if the original loan was greater than $2 million. And then we have our representations and certifications where we do have a couple of new ones that are on there. The form also includes the Schedule A, which is where we have the detailed calculation of cash and non-cash compensation, our full-time equivalents, self-employed owner or partner compensation, and then calculations of reductions for reduced pay or the FTE count. Then the Schedule A worksheet has two tables. The first is the listing of employees who made less than $100,000, their FTE counts, and any pay reductions. And then table 2 is our listing of employees who are greater than $100,000 and their FTE counts. And then we have on the same Schedule A worksheet the determination of any safe harbor for rehires by December 31st, 2020. So if we walk through the application, again, this first part of the application is just all of the general information as far as the loan amount, the loan number, the disbursement date, because again, that begins the start of your covered period. We have the employees at the time of the loan application, and then the employees at the time of forgiveness application. And again, that number is going to be important if you are applying for forgiveness before the end of your 24-week period. Again, you're also going to list if you have any EIDL advance, because that is going to, again, affect your PPP loan forgiveness. Your payroll schedule, again, if you're weekly or bi-weekly, you do have the ability to select that alternative covered period related to your payroll. And you also note that then if you are going to use that alternative covered period. So on the forgiveness calculation, okay, this is the only thing that's different here from our EZ calculation is that, and we have that section in the middle, which is lines 5, 6, and 7. And this is going to come from our Schedule A worksheets. And we're going to list if we have any salary or hourly wage reduction amounts and any FTE reduction quotients. But again, as Becky noted, if you are using the 24-week period, that even if you have reductions on either of these lines, there is the ability to mitigate those reductions just because we are looking at a 24 weeks of payroll when your original loan amount was only based on 2.5 months of payroll. So again, if it looks potentially like you are going to have a reduction in either of these categories, you are much better off to go ahead and wait till the end of your 24-week period to be able to maximize the amount of dollars so that it can mitigate any of that reduction. So on the applications, the certifications, again, the first one, the main thing that's different here is that we're talking about the payroll costs have to equal at least 60% to be able to, you know, have that forgiveness amount or to maximize your forgiveness. And then the second change in the application, the certifications, is related to the borrower has to, if the borrower has checked the box that says that they were unable to operate at the same level of business activity in order to be able to get that FTE safe harbor. So those are the two changes from the original loan application related to the certifications. So on Schedule A, the first thing that we have here is what we're just trying to determine our cash compensation and then the average FTE. And both of these are going to come from the worksheet from Table 1. And then line 3 is where we're going to list if we have any salary reductions greater than 25%. And again, that's all going to come from our Schedule A worksheet Table 1. The Schedule A worksheet Table 2 is where we're going to look at cash compensation for anybody who is greater than $100,000 and list their compensation and then their average FTE. And then on our non-cash compensation payroll costs, this is where we're going to list our employee health insurance, the employee retirement plan contributions, and then any amounts paid or incurred for employer, state, and local taxes assessed on employee compensation. So on our, this again is a continuation of any compensation to owners. And then when we get to the, our total payroll costs, then we have to calculate if we have any full-time equivalency reductions. So if we check either any of the boxes in these next 3 lines, then we don't have any full-time equivalency reductions. And then we can just, you know, check the box, put 1 on line 13 and move on. So the first one is if you don't have any reduction at all in your employees or the average hours, then you just check that box and move on because you've not had any furloughs, you've not reduced salaries. So again, that's the simplest one and really requires like no calculation. The second one is that first safe harbor, which is now the new one. If you were not able to operate at the same level of business activity as before February 15th, you're going to check that box. Again, you also have to make the certification on the application that you were not able to be at the same level of business activity. There's not a requirement at this point that that gets turned in with the loan application, but that would be documentation that you would have to maintain in case, you know, the SBA came in and audited, or your bank may require it, you know, just for their records to be able to show that they have that documented. Then this second safe harbor reduction is just the one that has always been in the guidance. And this is just related to if you reduced your workforce from February 15th, 2020 through April 26th, 2020, you have the ability to, again, mitigate that reduction. And that's going to be either by the application date or December 31st, 2020. So these are the Schedule A worksheets. Again, Table 1 are for all employees who made less than $100,000. Table 2 are for all employees who made more than $100,000. You know, as Becky indicated in the calculation that she did in a previous slide, it really can make a pretty significant difference whether or not you actually, you know, calculate your full-time equivalent based on actual hours, as opposed to taking that alternative method and just doing, you know, those who work 40 or more are 1, and anyone who works less than 40 is, you know, 0.5. And I know if you're somebody who, you know, has like a lot of employees, I mean, if you're somebody that's at that, you know, 450, you know, range, to have to track this employee by employee, you know, will be a pretty significant task, but it really is the only way to be able to determine if you have the reduction in your full-time equivalent and or your pay. So again, it's gonna be a big calculation. And I know to try to do that both ways for the full-time equivalents could look like a pretty daunting task, but again, it could make a significant difference. But also take into account that you do have the ability to more than likely have any reduction mitigated by taking this out to the full 24 weeks. So this is for the safe harbor reduction, that second method, which was again the original mitigation in the original law. And this is where we're going to look at the total FTEs between February 15th and April 26, 2020. You're going to compare that number to the FTE equivalent on February 15th. If 2 is greater than 1, then you're going to go on to 4. Otherwise, you don't have the ability to mitigate. And this is where we have the change in the language. So you enter the borrower's total FTE as of the earlier of December 31st, 2020, and the date that this application is submitted. So again, if you're submitting your application before the end of your 24 weeks, then you're going to be looking at your full-time equivalents on the application date as opposed to December 31st, 2020. And then again, if step 4 is greater, then you're going to, you're going to enter 1. That's going to go on to your line 13 on your schedule PPP Schedule A, and there is no reductions because you've met the safe harbor. So now we're going to look at the process to obtain the loan. So the borrower is going to complete and submit the loan forgiveness application to the lender after your forgiveness period. There's no deadline stated, but interest will start to accrue. And if the application is not submitted at least 10 months after your forgiveness date, then the amount's not going to be deferred any longer, and you will have to start making principal and interest payments at that point. Again, as we've already noted, that the date of the forgiveness application is now important in our FTE or pay rate restoration. The lender will review the application and make a decision regarding loan forgiveness within 60 days and issue a decision to the SBA. As we already mentioned when I started my talk, is that each lender is going to have their own timeline for when they will begin accepting applications for that process. So just, again, reach out to the lender that you obtained your loan from to find out what their process will be. The SBA, subject to any SBA review, will remit the appropriate forgiveness amount to the lender within 90 days. The lender will inform the borrower of the loan forgiveness amount, and any unforgiven amounts must be repaid on or before the maturity of the loan. Again, in the original PPP guidance, the due dates were going to be 24 months after the disbursement, and then the interest was going to be at 1%. That 2 years has now been extended to 5. If you did get your loan on June 5th or before, your original documents will still say 2 years, so you have to reach out to your lender again to get those documents revised to make that 2 years now be 5 years, and then the interest rate still remains at 1%. So it should also be noted that the general loan forgiveness process applies only to loan forgiveness applications that are not reviewed by the SBA prior to the lender's decision on the forgiveness application. And as previously communicated, the SBA has the authority to review any loans within a 6-year period following the date the loan is forgiven or paid in full. So this process, again, it could be ongoing for several years. So the documentation that's going to be required to submit with your loan application, and again, your individual lender may require additional documents besides this, but these are things that is in the guidance clearly says that you have to submit, are copies of payroll reports for each pay period. I know there are several payroll providers who are generating reports that can be submitted. Just make sure that you're reviewing those reports to ensure that the information that's being captured is correct. You're going to have to submit documentation reflecting the health insurance premiums paid. So that would be any invoices and copies of remittances, documentation of all retirement plan funding by the employer, for the original 8 or 24 weeks following the origination of the loan, copies of lease agreements for real estate and tangible personal property, along with proof of payment, copies of all statements of interest paid on mortgage obligations incurred prior to February 15th, 2020, and then copies of canceled checks, statements, or other evidence of utilities paid. Now, this is documentation that, while it's not required to be submitted with your application, you are required to maintain for at least 6 years from the later of the date the loan is forgiven or paid in full, documentation supporting each individual employee in the Schedule A worksheet Table 1 and Table 2, any employee job offers or refusals, firing for cause, voluntary resignations, and written requests for work schedule reductions, documentation supporting the PPE Schedule A worksheet FTE reduction safe harbor, and then supporting documentation on the borrower's necessity of the loan request and eligibility. So that would just include if you, met with your board and presented copies of budgets, cash forecasts, anything like that that supports your original necessity request for the loan eligibility. You just want, that's the documentation that if you want to maintain. And it would be very important to have that documentation, or the original request or approval to apply for the loan, to have that documented in your board minutes. So now we'll entertain some questions if we have some time.
Great, thank you, Theresa and Becky. Really appreciate the thoroughness of the presentation today, as well as the examples. Folks, if you have questions, yes, please submit them in the Q&A box. We do have a few on there already. And for those who already have submitted a question, if you felt that the question has already been answered, could you just let me know either in the Q&A box or the chat room? That way we can make sure at least to get through as many questions in our 15 minutes that we have left. As I mentioned earlier this morning, for questions that we don't get to by the time that we end today, rest assured we will get those questions answered for you offline, and I will send them all to everyone who registered for the webinar so that you can review the answers to those questions. So with that, our first question is from Sarah. We have a semi-monthly payroll, 15th and 30th. Can we use 4 full pays, May and June payrolls? We received our PPP funds on April 24th.
Yes, you should be, based upon the fact that we're using now incurred or paid language, or I should say paid and or incurred language instead of the and, it would allow you to use those full payrolls because when you're looking at the amount that is paid in May, that would have been the actual paid period. And if you're looking at your June payroll, if it extends beyond the 8-week covered period, first off, you could choose the 24-week period, but then alternatively, it would have been incurred. As long as it's paid through the next cycle, you would be fine.
All right, great. Question from Jane, is that forgiveness process lender has 60 days and SBA has an additional 90 days for a total of 150 days?
Yes, that would be correct. And again, that's not saying that it would take that long, but that is the amount that each party has when they're doing the review.
And a question from Beth, for the 40-hour method and alternative method for calculating FTE, is this calculation just done at June 30th or December 31st? Or is it done for each pay period along the way?
Done for each pay period along the way in looking at that full-time equivalency component. So whatever period is being used for the documentation of full-time equivalency to determine there was no reduction, it is done for each one of the pay periods during that period where you're using, remember you have choices of what periods you want to use for that full-time equivalency reduction component, and you calculate it for each pay period during that period for the calculation.
Great. And also, if you depleted your PP funds in August, do you have to wait until the end of the year measurement date if your 630 numbers were too low?
If your 630 numbers were too low, you have then used all of your funds and you have determined that you would get complete forgiveness come August, you could do your forgiveness application in August, assuming that all your mitigation and your calculation would work out properly at that point in time.
All right, great. Thank you. All right, here's another question. We had part-time employees who have voluntarily taken unpaid leave due to recommendations by doctors. We still maintain their full hours and staffing, but have individuals on our payroll who will not have hours reflected on the forgiveness report. Will there be any ramifications for this? Do all individuals on our payroll need to show they worked during the forgiveness period?
Yeah, so since that was a voluntary on the part of the employee, it will not affect the full-time equivalent or the pay. But again, you just want to make sure that you have written documentation from the employee that it was their decision to either reduce their hours or to reduce their hours to 0.
Great, thank you. Question from Holly, can you separate and still follow the rules if restricted donations can be applied to payroll expense for over the allowed amount of 100,000?
So
I'm not sure I'm understanding the question.
Yeah, it sounds like maybe they're asking if they can use restricted donations for anything over 100,000. And if that's the case, then I would say yes. So if they're saying, can we use our PPP funds up to 100,000 and then use restricted donations for anything over 100,000, then that would be allowed because you wouldn't be double dipping.
I would agree with that, but I also would say that I would consider using my restricted funds first, especially since there's the opportunity, as you indicated, Theresa, whenever you were calculating amount of payroll for the original loan, it was 2.5 months. Now you have a 24-week period. You possibly could use all your restricted funds first and then still have complete forgiveness by using the payroll dollars that were not paid with restricted funds in your calculation for payroll or for PPP forgiveness. So I would kind of look at it a couple of ways and determine which is going to be best.
Okay, great. Holly, if that answers your question, if it doesn't answer your question, let us know and we can follow up. All right, the question from Susan. Thoughts on how the forgiveness is to be recorded? Is it a contribution?
Well, there are various ways that can be done. In fact, was participating in an AICPA conference, their not-for-profit conference this past week, and there was a lot of discussion about various methods that could be used. The most appropriate method, I believe, this is personal opinion, and because they're choices, an organization is going to need, especially if you're in an audit situation, the organization is going to have to look at the various choices that exist as to whether it's loan and loan forgiveness or whether it's a contribution, and support the reasoning for the methodology that you're using and ensure that you properly disclose that in your financial statements. But editorial opinion, because I always like giving my opinions, they're free. I do believe that going with the contribution method rather than loan forgiveness method is the best methodology for our not-for-profit organizations. The big question that exists in my mind at this point in time is when we're looking at forgiveness from a conditional standpoint, whether we're going to look at the SBA's and or the bank's forgiveness as being administrative, which means that as soon as you would make your application, you've met the conditions and therefore you would recognize it as a contribution, or whether you're going to consider that forgiveness element that will come from the bank and or the SBA as being more than administrative in nature, which means that you'll not recognize the contribution until you actually get forgiveness component from actual official forgiveness rather than just the submitting the application. Those folks that have an early on component, I'm not sure, and when I say early on, you're a 630 year end, and therefore there's not been a lot of forgiveness applications that have been made, and we don't know how all of this is going to play out from timing and what's going to happen with the banks. And you remember we had banks handling things very, very different ways whenever we were doing the loan applications. I question whether it's just merely administrative or not, especially for those early on applications. Once we have a track record, I could say that yes, there might be support for it being purely administrative. So consequently, I think you have a lot of choices, and the biggest element is to document your reasoning for your choice and disclose it properly in your financial statements.
Terrific, thank you. All right, another question here from Mark. Can you begin deferring payroll taxes at any time? Can you continue deferring payroll taxes after the 24-week period?
Yes, you can defer payroll taxes. Payroll tax deferral could have started, forget the actual date. It would have been, let's see, the latter part of March is when it could have started. And it can be continued through December 31st of 2020. So if you've not started that, I suggest that you start it now, because as I indicated, you've got an interest-free loan that you have available to your not-for-profit from now through the end of December.
And I'm not sure they've actually done it. I don't know if you've seen this, Becky, but they're supposed to be revising the second quarter Form 941 to be able to show, to reflect if you have deferred those payroll taxes.
Right.
I have not seen it, but yes, you're absolutely correct.
Okay, great. Angela has a question. Do rent and utility expenses have to be included in PPP forgiveness calculations, or can all PPP be used for payroll costs only?
Yeah, it can all be used for payroll costs. I think, you know, that the rent and utility and the things were put in there because, you know, originally when you look at the original 8-week period and the fact that that the loan was based on 2.5 months of payroll, it would have been hard, if not impossible, to do it all with payroll. But now that we have the full 24 weeks, you could very easily be able to meet your full forgiveness with just payroll.
All right, another question here from Lorraine. If we are a reimbursing employer, meaning we must repay the state for unemployment paid to our laid off employees, is the reimbursement paid applicable to forgiveness?
Yes, that as long as it is incurred or paid during that covered period, yes, it would be.
Excellent. Michael has a question. If you receive the EIDL $10,000 advance, do you include it in the total loan amount, PPP loan plus EIDL advance, prior to calculations for forgiveness?
No, you would only include your PPP loan, and then any amount that you received from an EIDL loan would reduce the amount that would potentially be forgiven. So you don't include the two and then subtract the EIDL, you just include the PPP and then subtract your $10,000 EIDL amount advance that was received.
All right, Mark has a question here. Where on the EZ form would you document a reduction of payroll from use of grant funds? Can you document the reduction amount with a grant reimbursement invoice total, or must this be done by individual employee?
So I know there's nowhere on the form to be able to document that. So it would have to be like just a separate calculation where you showed like, you know, like total payroll and then the total payroll that was being reimbursed versus a grant. And so this was the amount that you were submitting to be for your PPP loan forgiveness.
All right, will there be a footnote disclosure needed since there is a 6-year window for these loans to be reviewed? Any additional disclosures being advised at this time?
So there will definitely be, you know, a footnote disclosure that's just related to, again, then this will depend on how your organization is going to handle it, whether you're going to consider it a loan or a, you know, conditional grant or contribution that would be shown as a refundable advance, and then you would have footnote disclosures related to that. But once you get the forgiveness, I'm not really aware that there would be an obligation to have an additional footnote related to the potential that, you know, you have a 6-year window for a look back.
I wouldn't think that that would really be necessary. There's a lot of footnotes that organizations will include in their financial statements that will just be a broad footnote related to potential contingencies, especially organizations that have a lot of governmental funding that they receive. There's, you know, a footnote that indicates that the organization does rely on governmental funding and there could be reviews of those, et cetera. If there is concern about the potential, then I would say, yes, you might want to document that and disclose that in your financial statements. But generally speaking, I wouldn't think that it would be necessary.
All right, Bonnie has a question here. Please expand clarification of what is considered, quote, restricted.
Restricted would be amounts that donors or funders have given to you and said that these funds are to be used for a specific purpose. The major concern with regards to PPP is that, in essence, from a governmental standpoint, you're double dipping, and the governmental funds are coming through governmental grants or governmental reimbursements, et cetera, and then being used for forgiveness from for your PPP loan.
All right, let's see, we have only 3 more questions left.
Okay.
So if we can, just maybe we can answer these and then we can sign off. So Sarah has a question. If we have an employee who resigned voluntarily unrelated to COVID on April 2020, does that impact our FTE calculation?
No, it does not, because they resigned voluntarily.
All right. Angela had the follow-up to earlier question about semi-monthly payroll. Can you use those PPP funds for April 30th payroll?
Yes, so if you received your disbursement of your PPP funds was on April 29th, you have a payroll on April 30th, yes, you can use your April 30th payroll in calculating the funds for forgiveness.
Great. And then our final question today from Jerry, what if it spans fiscal years? The loan was given in 1920 but forgiven in 2021 relative to how it's categorized admin or contribution?
Yeah, so I think that'll go back to what Becky was just talking about. Again, just related to each organization is going to have to look at that. But if say your organization has a June 30th year end, at June 30th, you're going to have some kind of a liability on there, whether it be either a loan or a refundable advance, depending on how your organization is going to make the decision to reflect that in the financial statements.
Great. Well, I think that's it. I think we covered it. For those of you who still have questions following the webinar today, feel free to email them to me. I'll make sure I'll send them over to Theresa and Becky. But thank you both, Becky and Theresa, for leading us through this session today. Everyone, we will send you a copy of the slide deck along with a link to the recording of the webinar so you can replay it or share it with those you think could benefit from the information. If you don't see my email by the end of the day tomorrow, please check your spam folder. If you still don't see anything, please drop me a line and I'll be happy to resend. Once the webinar ends, a link to a feedback survey will appear, so please take a couple of minutes to fill that out. Finally, our next webinar on virtual events will be on July 15th. We have Nikki Bell and Simon Scrivener from Fundraising Everywhere, and they will take us through steps and learnings of developing online engagement events. They will actually be joining us from all the way from the UK and Ireland, respectively, so I hope you can all join us for that. Again, we invite you to interact on our nonprofit Facebook group page and follow us on social media. So with that, on behalf of everyone else here at CMPE, thank you again for joining us today, and we'll see you all again next time. Thank you and have a great day.